We're delighted that our strategic partners, BMO Harris and Atomic Data, are joining us this morning to host our final 2 professional development sessions of the season. In our first session, BMO Harris will lead a panel discussion on how your business and personal taxes may be impacted by upcoming tax changes. In our second session, starting at 9, Atomic Data will lead a very timely discussion on the benefits of data recovery as a service. And for those of you that are staying on for the second session, no need to exit out of your session. You'll just stay on the same link. Before we kick off today's program, I would like to make you aware of a couple of upcoming events. We invite you to attend FEI Twin Cities annual meeting to be held virtually on July 14th from noon to 1 p.m. Board members will provide a recap of highlights over the last year and share plans for our upcoming season. This should be a fun, interactive event. And join us also for an in-person social on July 20th at Sociable Cider Works in Northeast Minneapolis. This will be a fun, casual evening of catching up with other FEI members, strategic partners, and guests. Join us as your schedule allows between 4:30 and 7 p.m. The evening will include cider, nano batch beer, food, outdoor games, and more. You can register for these events and more at feitwincities.com. And now I have the pleasure of introducing Derek Weatherford, Managing Director, BMO Private Bank. Derek will introduce our panel of speakers and moderate our first session. Derek?
Good morning and thank you. Excited to be here today. Thanks for the opportunity. At BMO Private Bank and Trust Company, we're focused on helping individuals and business owners understand their full balance sheet and offer full balance sheet advice and helping them understand what's most important to them and their families. Today, I'd love to introduce and extremely honored to be partnering with 3 folks today, very knowledgeable in this area. First is John Fortin. He is the Redpath and Company Tax Director for Estate Gift and Trust. Dave Jocelyn, he's a partner at Best & Flanagan in the Private Wealth Planning section. And very excited to have Mike Berry, President and CEO of Twin Cities Fan, joining us today. Our panel will discuss a few topics ranging from tax policy, strategy, and implementation. And we're looking forward to sharing these ideas with you and having a great discussion. In the meantime, there will be some polling questions that come up throughout our time together today. So as they come up, please feel free to answer those, and we look forward to great interaction this morning. So I'll just jump right in and get started. Good morning, gentlemen. Thank you for joining us today. Excited to have you. You each bring unique experience to this discussion from various points of view, and I think that's very exciting for our guests today. So I will start with the first question to John regarding tax policy. What are some of the key tax proposals on the table in this proposed Biden tax plan?
Thanks, Derek. Appreciate you inviting me to be part of the panel, and look forward to a good discussion today. It's a great question. Let me kind of walk through some of the proposals that are out there, as well as maybe put things in a little bit of a context as well for where we are and what the current law is. Because right now we have a exemption of $11.7 million per individual, and married couples can exclude $23.4 million from estate tax. Also, if you have assets exceeding those amounts, then you can potentially have an estate tax starting at 40%. What else we know at this point is that this exemption level is really much greater than it has been historically, and came about as a result of the 2017 Tax Cuts and Jobs Act. What we're also going to find is that tax law has a sunset provision. So as we look forward to 2026, we're going to see that the exemption will automatically revert to a 2017 inflation adjusted amount, which is going to be roughly $5.5 to $6 million per individual. So whether we see some of these proposed legislations come into effect or not, we are going to see a decrease in the estate exemption. So it's something that we're looking to plan for with our clients currently, and really where we're going to see some changes or potential changes is how we go about planning with our clients. At this time, we're really talking with them about using their lifetime exemption to lock in this increased exemption level, using strategies that involve grantor trusts, grants, gifting, valuation discounts. And here's the reason why I'm going into saying what all these techniques are that we're using today with our clients. As you're going to see, the proposals that are being introduced are significantly going to reduce the ability to use these, and in some cases they'll be wiped out. Let's talk about some of these plans that are going to potentially be out there. There's really three plans to look at. There's the Sanders plan, which some people have heard of the 99.5% Act. And really, if you look at this plan, Bernie Sanders has introduced this plan every year for the last 10 years. So there's not a lot of new thoughts out here in it, but there's, I think, two things that make this plan more relevant. One, we've seen a change in the guard in the Capitol. So the Democrats now are control of Congress as well as the president. However, there's not a supermajority there. So the ability to pass sweeping tax legislation may not be there. I can't say that they will or they won't, but it's going to be harder for them to pass sweeping legislation. Second thing that makes this more relative is that this legislation is written and is ready to go. So what we're going to see though this year is there's going to be an additional budget reconciliation process. And what could happen is that somebody who may need a revenue source could look at some of these proposals and say, hey, this one fits what we want. And let's go ahead and we'll attach it to our budget and we'll get it through. This has actually happened in the past. A few years back, there was, I think it was a transportation bill. And they were trying to come up with a revenue source, and they happened to look over and see that, oh, in one of Sanders' proposals, that was in a bill such as this, it hit the right revenue mark, and so they attached that into the budget. So that's where some of these reforms may come into play. But let's talk about some of these specifically. So first thing that we all have some concern about is what the effective date is going to be for this legislation. The Sanders legislation does say it will become effective as of 1/1/22, which will give planners and clients the remainder of the year to get something done. Within his plan, he's going to roll back the exemption level to $3.5 million per individual for your estate tax. Now, earlier I said that through gift or estate, you can pass 11.7 today. Well, if we look at what was going to happen on the gift tax side, there's going to be a lifetime exemption amount of $1 million. So instead of today where we could say, let's go ahead and gift 11.7, if this bill and legislation passes, we would be able to say you got $3.5 million of exemption that you can use, but you can only use $1 million of that exemption during your life. So there'll be a little bit different planning dynamic there. The other part for the gift tax bill is that, as you're probably familiar with, each of you can give $15,000 a year to a donee, and that falls under your annual exclusion. Well, for some some entities are set up where we have a trust, let's say that has 4 beneficiaries, and we make a gift to the trust, and it has the ability to exclude $60,000 of gift to that trust through the annual exclusion. That's now going to be capped at $30,000 under this legislation. So we may have to go back and look at how our distribution or contributions to trust are structured. I mentioned earlier we're using grantor trusts and grants. Grantor trusts would no longer be exempt or out of your estate. So today, what we would do with some clients is we can help them set up grantor trusts where they make large gifts or sales. Let's say they put $1 million in, it grows to $5 million at the time of their death. That's all out of their estate. With this proposal, they would make $1 million gift to this trust. And then at the end of the day, if they hadn't paid any gift tax for the gift to the trust, that $5 million that had grown in appreciation would all be back into the estate. So that's going to be a huge change in our planning techniques going forward. Also, valuation discounts. Currently, we work with clients to help structure and obtain valuation discounts for maybe the entity that they're looking to gift. For non-business assets and passive assets, no discount will be available. And if you are doing a family transition of a business, the lack of marketability will be taken off the table as well. So the ability to gain leverage from using a discount strategy is going to be taken away as well. GRATs, grantor retained annuity trusts, have been very successful with these over the years, and they've been really great because most of the time we'll structure them, let's say a 2-year term, and the trust can be written so that there's a very de minimis gift that is involved with the transfer. Under the Sanders legislation, it will be a minimum of a 10-year term, and you'll have to realize at least a 25% gift of what is of the asset that is put into the GRAT. So where we're able to give lots of appreciation away before with very de minimis gifts, we're now going to have a bigger gift to realize up front, as well as a much longer term. So a little bit more difficult to plan with that. Generation skipping tax. Some of you are aware that we are able to create trusts and fund them in such a way that they'll be able to skip generations with the idea that we can continue to keep those dollars that are in the trust from being subject to estate tax for future generations. In some states, we can actually set up dynasty trusts, which basically those assets can avoid estate tax in perpetuity. Well, under this bill, there would be a provision which basically says for every trust that is out there, once it hits a term of 50 years or more, it'll automatically have an inclusion ratio of 1. So what that means in English is that every time that you make a distribution from that trust to a grandchild or some future beneficiary, at this point, there would be a 40% tax on whatever was distributed. So if you distribute 100,000, you've got a $40,000 gift or tax associated with that. So those are the highlights of the Sanders plan. But the Biden plan is out there as well. It's really more driven to be an income tax plan, as you probably are aware. Corporate rates up to 28%, increasing individual rates to 39.6 as the top bracket for those earning over 400,000. For taxable income over $1 million, your capital gains and dividends will then be taxed at the 39.6 rates. But where we start to get some of the estate implications in the Biden plan is that he too would lower the exemption to $3.5 million. And he was also looking at taxing unrealized gains. So at your death, instead of having a step up in basis and being able to pass those assets to your beneficiaries, there'll be actually a realization event for capital gains. So that now, when you die, you have capital gains on your assets. There will be an exclusion of the first $1 million of capital gain will be excluded. Some tangible property will be excluded. And there's also the benefit of, well, if you do have to pay the capital gains tax and you pay estate tax, you get to take a deduction for the capital gains tax that you pay. So that's something that's pretty radically different than what we've had for a long time. The other part on this is that if you're making gifts to non-grantor trusts, that would be seen as a realization event as well. So instead of being able to gift your stock into a trust for your family without any capital gains tax, now that's going to be a capital gain taxable event.
Hey, John, you mind if I step in? That I know that yeah, there's a ton to cover, and you've laid the groundwork, which I appreciate greatly. I know the audience does as well. As we go through this discussion a little bit further, if there's some additional things that you want to add, that would be fantastic. I wrote down estate tax, income tax, capital gains, step up in basis, corporate tax. So many things could be changing, and although we don't know for sure what's going to happen, I know it's almost impossible to lay the entire groundwork in a short period of time. You've done a great job, and then we'll loop you back in for some additional comments. So I appreciate that, John. Thank you. David, let me jump to you really quick from an estate planning professional's perspective, drafting these estate plans, et cetera, and talking about some of the issues. What are two of the key things that you're hearing clients are concerned about?
Sure. Thanks, Derek. Thanks, everybody. Well, concerns for clients haven't really changed with these proposed tax changes. I think clients are still concerned about their families and their businesses, and how to ensure that their legacy and their objectives are carried out. So, when I meet with a client, my first question isn't, how to save every tax dollar. It's what are your goals for your family, or what are your goals for your business? So, sitting down and thinking about if you're a business owner, governance questions. If something happens to you as a business owner, how do you want your business to be governed? Who's in charge? Is it something that we want to keep in the family? And working with my corporate attorney colleagues on governance issues. And then what's your goals for your family? How are your kids? Is everybody healthy? Grandkids? And making sure we're considering that. And then we layer in the tax issues and how can we achieve your goals while being prudent on the tax side. As John said, and we've already mentioned, that we don't know what's going to happen with these tax proposals. Every year we have tax proposals out there, different situation politically. So what I'm working with clients on are, let's assume there's going to be a change. We don't know what that change is, but we have 6 months to put some groundwork together, to put documents together, and to be able to execute on a strategy before the end of the year. But you have to start that process now. Any planning technique that involves a family business or significant amount of wealth involves a team approach. So that means meeting with the estate planning attorney, the accountant like John, someone like you, Derek, who has a good handle on the wealth plan and the balance sheet, and starting to forecast financial projections, thinking about if gifting assets is on the table, how much can we gift? As John said, right now, a client could essentially write out a check for $22 million, a little more than that, to their descendants and not have to pay any gift tax on that gift. That's a tremendous asset that may go away. So clients are thinking about that. We're running these projections, but we're also making sure that we relay to the client that if a tax law is retroactively passed, which seems unlikely but is possible, that client could face a tax on a gift they make this year. So it's really important for the advisors, the client, the business owner, CFO, whoever's involved, understands that gifts this year could become taxable. And even so, that may be okay. That may be a good outcome long term, but the client has to have the cash on hand to pay the tax and understand that that's a possibility. So, in summary, the conversation, I think, is very much the same. It's goals for your business and your family. But now we've sped up the conversation about transferring wealth into the next 6 months instead of, the 2026 sunset of the Trump tax legislation. So I leave it there.
Yeah, thanks, David. Appreciate that. Mike, before I jump over to you, Nancy, could you put up the first polling question, please? Wonderful. Simple. Do you have an estate plan? Please take 10 seconds to answer the question if you need it. Appreciate you doing that. Perfect. Mike, let's come to you. As an individual and a business owner, what are a couple of the key tax proposals that might concern you and your family the most? If you could rank them.
Yeah. Good morning, Derek. Thank you. And good morning, everyone else. I'd say all of it, frankly. As a family, we've certainly understood the complete tax laws as they stand today. Businesses such as our own like certainty about the future. And as we get into our strategic planning process, as we start planning for next year, it's going to be a big challenge for us to understand. We have foreign operations, so we're concerned about profits generated overseas. As we, as a family, look, we're early, but as we look at transferring the business to generation 3, significant concerns. I know that they often talk about family farms. I don't know if the family farm sits the same way, but I'd say many privately held family-owned businesses, this is going to put significant pressure on how does a family keep the business going forward. M&A activity is very hot in the market right now, but if you wait just even 6-7 months and close after this year, in theory, you're going to have to sell your business for almost 20% more just to stay even. It's not sustainable. And so we are quite concerned about many of the aspects. Even the increase in the corporate tax, understand some of the needs of the country, but at the same time, to make such a radical shift from one direction down and then another direction back up, this is very difficult, number one, for businesses, and number two, especially for family-run businesses. We're quite concerned about those issues. And many of the good plans that we've put in place over the last 10 years or so, many of those foundational pieces, are at great risk for being sustainable over the future. I could go on and on. There are literally dozens of different things. And so those that are planful and have thought about this, in many ways, they could be penalized and hurt the most. We take full advantage of grants. We take advantages of dynasty trusts, South Dakota dynasty trusts. And so as much planning as you try to do, it's going to be a real big challenge. We pray not that they go look back to 2021. I do think now that it's July, it's going to be a difficult thing to do, but it is certainly possible. So Derek, I'll stop there. I'd love to go on for 2 hours on that.
Yeah, thank you, Mike. And in our strategy portion, I have a couple of questions for you that I think the audience will appreciate hearing your perspective on. Let's jump to strategy quickly. So John, I'm going to send it back to you. as from a tax perspective, as families and business owners come into the office and they say, oh my gosh, all these tax proposals are on the table. If you had to pick two I needed to focus on as a priority, which ones would they be?
Two that you got to focus on. Well, since I'm the estate guy, I guess I'm going to look at the exemption level, being able to take care of that. I would say if you're going to use that to use the exemption, and then also if you could use a free strategy, such as maybe also a sale to a grant or a trust or something like that. And the reason we want to look at that now is because some of the legislation we talked about with Sanders, where the grant or trust will be brought back into the estate, those that are put in place prior to this legislation going in can be grandfathered. So there's still time to get some of these ideas put into place. But really overall, to kind of piggyback on David's point, let's first make sure that we're doing the right thing and setting up your estate and your business plan so that you can really maintain your lifestyle first of all, and then build a plan to work with that.
I appreciate that, John, and I appreciate you thinking. That's why I think your firm, David's firm, really good at thinking big picture when you're working with your clients, not just your specific area of expertise. And David made a comment earlier. Certainly, my team focuses heavily on understanding family values and purpose for wealth. Do you have a family mission statement? Making sure that as an audience, you want to know that your advisors are asking those types of questions so they really truly understand, because certainly tax planning is important, estate planning documentation is important, but all those things can't happen unless your advisory team knows the purpose and intent for your wealth. It's important to have those questions discussed. David, oh, sorry, let me jump really quick to a second polling question, Nancy, if we could, because we heard a lot of things: taxes, governance, succession planning, estate taxes. What topics are you most concerned about for your family and or business? Thank you. And while we get the answer to that, were you surprised, David, on the first response that showed about 50-50 people have estate plans, people don't have them? What are your thoughts on that?
Yeah, I'm not necessarily surprised. I meet with clients every day that haven't put their estate plan together, including other lawyers and tax professionals. But now's the time to get it done. Again, taxes are a big issue for a lot of folks, but again, taxes are just one piece of the puzzle. If something happened to you tomorrow, how is your wealth being distributed among your children? Do they understand how to manage that wealth? Do you have the right fiduciaries in place? If you have minor children, do you have guardian appointments? All those are really critical components. And I'll just say it again that it's nearly July, and it's going to be a busy end of year for accountants, lawyers, and wealth planners. So start the process now, because if you call us in December, it's unlikely to get done by the end of the year. I will. I'm thinking back to 2012 when we had a similar event where we thought the exemption was going to go down. Forget the numbers, but I think it was the exemption was at maybe 3 million, and we thought it was going to drop down to 1 million. And what ended up happening is that over a weekend, the exemption went up, and we got the concept of portability, a different political makeup in the Congress and the White House. But this is why it's so important to be thoughtful, because after that, we found a lot of clients made lots of gifts during that period of time that regretted it because they hadn't done the financial forecasting and they hadn't thought it through with their planners. So it's all about really educating the client and having the key advisors at the table to do the forecasting and really think hard. Now, document drafting is not the hardest part of this process. The hardest part of this process is the client really understanding what they're doing and the outcomes of the plan.
Yeah, and it's extremely emotional, right? The process can
Right.
be very emotional for families, which leads me to a question for Mike. As people are rushing to their tax advisors, their estate planners, there's going to be a rush for the door, and those professionals are going to be overwhelmed as the year progresses towards the end. I know this about you. You and your family have done a lot of planning for many, many years. And you don't technically have to rush, although the tax proposals concern you, as you mentioned before. Why have you been so thoughtful for so long about the concept of estate and tax planning?
So it said, we don't want taxes. We don't want the tax tail of the dog to wag everything, but it is an area that I've always been concerned about. And so I think with proper planning ahead of time, you could really mitigate some of the challenges that you face there. I think as a family-owned business, building a pretty solid chassis, be it different trusts, different planning tools, I think is really helpful. I think that we have built a very strong, robust chassis. Certainly, it's going to have to be modified and changed with some of the changes in the proposals here. Might have to speed up timelines of things that we're thinking about, but there are certain pillars, silos that we've thought about, and so it's really having that game plan for each of the silos. If you try to look at everything in one shot, you can't boil the ocean, and so taking a little bit each year, just to review it, to make sure it's solid, make sure it's in good order, make sure it's compliant. That's really important. And so we're in that situation right now. But many of the tools that we use, be it grants, dynasty trusts, other types of trusts, many of the ways that we fund some of the tax liability, future liability for the next generation is through these insurance struts, ILETs, et cetera. And so we're quite concerned about what could happen as we try to deal with the taxes, as we try to do wealth transfer. So as we make premium payments into there, how's that all going to be treated? And so again, for me, it really goes to the uncertainty, but having a robust chassis in place and understanding the different silos ultimately is what gives me a little more comfort that we'll be able to manage. The only last thing I would say, and I agree with David, and I'm sure this group knows it quite well, if I make a plea to everybody, please do not wait until December. You're going to have quite a challenge. I think clients and their advisors could be in for some high stress. Long-term relationships could be strained because X advisor couldn't get Y done because they waited literally until the 11th hour. There's still plenty of time right now to get at it. So please, I beg everyone to start right now because it's going to only ramp up.
Mike, thank you. Yeah, no time like the present. And I heard you say a lot of things: patience, communication, flexibility, discipline. Don't wait. The best way to eat an elephant is take one bite at a time. And when you think about estate planning, both the emotional and technical aspects of those, no matter if you are a business owner or an individual, there are family dynamics that play into this. I think they're important to be thinking about. So that's wonderful advice, Mike. Thank you. Let me jump back to David for a second. When people come into your office, what frustrates you most when you're thinking about their estate plans and you keep meeting with families? What, I guess maybe a better way to ask the question is, what keeps people from implementing the estate plan strategy that you discuss with them?
Yeah, it's interesting. Probably the biggest issue that keeps people from getting it done is not necessarily the tax planning, it's the other issues. It's who's going to be guardian of children, who's going to be the fiduciary. It's the those questions that I've had clients, just can't get their arms around. And you try and you say, well, let's get somebody in here because somebody is better than no plan at all. So those are the surprisingly, some of the issues that really delay people. And, but it's different on the business ownership side, people who own small businesses. It's also governance questions. It's, what are the restrictions on ownership? What are restrictions on transferability? What are, how are my employees going to be handled? Do we think about private equity transactions? All these other issues are they're hard, and they're not decisions that you're going to make in an hour to 2 hour meeting with your estate planner. They're questions that you have to think a lot about. Like Michael was saying, it sounds like his family has thought about that a long time, and it's not an answer that Jonathan or myself or the corporate attorney can give you. The answer is in your family values and in that mission statement and in your long-term objectives. So yeah, we can propose all the tax planning concepts out there. We can put them up in front of you and you can knock them down one at a time. But it really comes down to family values. What are your objectives? And what are your goals long-term for your family?
Yeah, thanks for reiterating that. I do think if the audience takes something away, those key things need to be discussed within your family. So the last poll question, governance wasn't even something that people were considering. I thought that was interesting. So David, thank you for, I think possibly people weren't understanding what governance really means, but you did a really nice job of helping illustrate what governance means to a family situation. So thank you. Albeit taxes, obviously estate and regular taxes are things that people are very cognizant about on our Zoom meeting today. So that's why I think it's extremely important we keep that discussion alive. Nancy, if you could throw up the third poll question, I appreciate it, please. As you think about estate planning and the challenges with implementation, when was the last time you updated your estate plan? For those of you that actually had one, I think about half of you have an estate plan, half do not. As we wait for that answer, John, I'll jump to you. Let's say at Redpath and your team, you guys are seen as the main point person for a client's family, business owners, and individuals. When you're having these tax planning discussions, who do you think should be at the table to have those discussions?
It's really going to be a team discussion. It's because a lot of the tax implications that we are dealing with are coming from work that you're doing with your clients on planning, work that David is doing. So it should really be that team of advisors that are working with the clients to help with the taxes. We can do a great job of advising and helping to implement, but we need others with specialties in the drafting world, in the brokerage world, in the investment world, really, in order to make this work. So everybody has to be on the same page in order to really implement this process. Because the simplest things can derail the whole plan. Where we're working with a client and hey, they forgot to retitle this into the trust, and now it just doesn't work anymore. And it was something as simple as a phone call and working with the brokerage company to have really brought the plan to be as successful as it could have been. So really, all of your advisors have to be on the same page, and there needs to be somebody quarterbacking that, whether that be the relationship with your the CPA, your wealth manager, or your attorney. Everybody's got to be on the same page.
Yeah, thank you for that. I think all of us on the panel would agree. Your external advisors should all be communicating, and I do also agree that sometimes families and business owners may not have someone they turn to for what I like to call the last word. Who do you turn to for the last word, just for sage advice, not only about these types of things, but anything, quite frankly. And sometimes business owners say, well, I have I have my corporate CPA, my family CPA, my corporate attorney, my estate planning attorney, my wealth advisor, my insurance professional. And so there's a cadre of folks that are working on your behalf, but sometimes no one is really facilitating or orchestrating all the external advisors who are extremely important to the success of your family's situation. And so nominate someone raises their hand, but everybody should participate, because I know David and John, none of them would like to make a decision in a silo on behalf of a client. They want to know what the other advisors on the team are thinking about and how they are helping orchestrate the bigger picture. As David mentioned a few times, your family's mission statement, the purpose for your wealth, those things are crucially important to answer. So Mike, let me ask you a question. You actually gave some advice towards the end of your last comment, so thank you. Maybe what is one thing you've learned by making an estate planning or tax planning mistake in the last 10 years? I know I'm popping this one on you kind of last minute, but you've had some really great advice. But is there anything that you would say, gosh, I wish I'd have done this differently or thought of this sooner or what have you? Oh, you're on mute, I think, Mike. There you go.
One of the mistakes I think I made is how much of my estate I actually already took out of my estate per se. So the big piece is my ownership in the company. So I had just prior to the end of last year, I owned about 25% of the company, and I actually moved most of that out of my estate. And I think had I rethought about that, I may have not moved as much as I did out of the estate, but that'd be the one thing I have thought about, because once you move it out, it is hard to make some changes to it. Not impossible, but it can be a little more complicated. I think I felt better because I've now bought most of generation one out of the business. So there's a good chunk of the company, about equal amount that I own now. So it's out of, or it's in my estate and not in some sort of trust document or trust. And so that would be the one thing. It's the advice to myself is don't let the tax tail wag everything. And it can be tempting to do that sometimes. So it's every business owner really has to spend a lot of time around that subject, and don't rush that decision. And so that's what I did. I probably rushed my decision to move things out of the estate.
Thank you, Mike, for that honest perspective. And so what I think, John and David, this is something you hear quite often. Sometimes clients overplan. And wouldn't you say in 2012, David, you mentioned, and now this year, I think kind of like the stock market, there's recency bias, and people tend to roll with the herd, and so maybe not everybody has to jump to conclusions or over plan. Maybe John, let me start with you. From a tax perspective, how do you prevent people from over planning?
I would like to explain to clients right up front that there's going to be changes. It's great if I can work with a wealth management firm and they can really understand how much they are giving up and what that does to their cash flow in the future. But also getting into understanding the level of complexity that they're adding to their lives, because now there is going to be additional tax returns, there is going to be additional reporting and monitoring, and they have to be part of that. So I like to make sure that they're comfortable with knowing that, okay, I'm going to have to do these other things, and I'm going to take on more administrative roles and duties. And then, from there, it becomes an easier conversation to manage clients now that they've got that expectation.
Thank you. David, any additional thoughts on that?
Yeah, I think one of the most important parts of my job, I mentioned this before, drafting the documents is not the hardest part. It's educating the client on these strategies in a way that the client understands if you're going to make these gifts that we're discussing, these are irrevocable, right? With a question mark at the end. So, or an exclamation point at the end. So an irrevocable gift means that if the tax laws don't change, you can't have it back. Or if something unexpected happens, you can't just take it back and pretend like it didn't happen. We're not, holding gifts in escrow to see what happens. These are, if you're making the gift, you've made the gift. So it's really important for the client to understand what they're about to do and the consequences of that. So, the value that I bring, that John brings, is the expertise and the education, the experience of this is how this works. If I have a client call me up a year after we've implemented the plan and it's obvious they had no idea what they've done, then I failed at my job pretty miserably. I mean, I want to make sure the client understands every aspect of what they're doing, because it is a very big decision, especially if they're going to give up ownership interest in a business.
Yeah, thank you. So before we hit to the last poll question, Roseanne and Nancy would like to open it up for questions from our audience today for any of our guests.
That would be great. Thank you, Derek. If you have questions for our panelists, please type them into the chat. That would be great. And I will pop up our last poll.
Please. Happy to take any questions. Each professional on the panel has a unique skill set and experience as an attorney, a tax professional, and also Mike as an individual and a business owner, multi-generational business.
I would love to know, when do you start this process?
David, you want to jump in first?
Yeah, it starts as soon as you can pick up the phone and call your advisor, whether it's your banking professional, investment advisor, CFO. Get the team together, get appointments on calendars, because things are going to fill up with your team quickly. So even if you're not going to do it, just having the conversation is a good exercise.
Thank you.
Mike, were you gonna mention something there? Did you want to make a comment? Oh, you're on mute still.
I'm shaking my head in absolute violent agreement. I would even say yesterday would be the answer to get started.
Yep. Let's see. Question is the use of the exemption a good first in 2021? I'm sorry, I'm not sure if I understand. Is the use of exemption?
I think I understand.
Okay.
From a planning standpoint, is the first opportunity to use the exemption, and then after the exemption is used, maybe implement other strategies. And I think the answer is probably yes. I mean, the exemption is an asset that's just sitting on the table. So if you can afford to use that exemption, then do it, understanding all these issues that we talked about: retroactive legislation, and the irrevocability of the gift that you make using that exemption.
Before we jump to this tax question, John, if I may, to David here, what documents should be included in a general estate plan strategy?
Was that to me, Derek?
Yeah. Sorry, Dave.
Oh, sorry.
Yep.
Well, I like to go in phases. Michael was mentioning this earlier. The most basic document is a will or a revocable trust agreement, depending on the makeup of your estate. Healthcare directive is important. Financial powers of attorney in case of incapacity are critically important to stay out of court. So those foundational documents, almost everybody should have. And then from there, life insurance is a key asset. So is a life insurance trust important. But foundationally, the most basic is a will, healthcare directive, power of attorney. They seem simple, but you can't understate how important it is if something happens.
Thanks, David. John, question, is there any reason to consider paying taxes sooner under the Biden tax administration? Typically, we're advised to always defer. Great question.
Right. And I guess first I'll break it into maybe two responses. One is, so if you, for the estate tax, if you have an option of paying either estate tax or paying gift tax, if you actually run the numbers, you'll come out better by paying a gift tax. Because what will happen is that your gift tax will be spend down your estate. Whereas when you get your estate tax, you're also paying estate tax on the dollars that you're going to use to pay your estate tax. And then for the second, I would say, I guess, on the income tax, really, I think we're going to look at this and probably go back to some multi-year planning to say, is it better to pull income forward 1 year and push it back to avoid going over either that $400,000 threshold or that $1 million threshold. Because if I can accelerate income, knowing I'm going to have into 1 year, knowing I'm going to have a bigger tax year the next, it might be better off to accelerate income. But that's just going to have to really be an analysis done on a multi-year basis to see where you can really save tax dollars.
Thank you. Any last questions before we wrap up? Going once. Is there a way to contribute appreciated assets to a trust without paying cap gains? John, you want to take that first?
Sure. I mean, right now you can. None of these provisions that we've talked about that have been proposed are in place. So, if making that contribution to the trust, it'll have to carry the basis. You may want to consider, the capital gain rates at the individual and the trust and the net investment income. But yeah, you can contribute to appreciated assets.
And that's the best strategy right now, right, John? I mean, if you're going to give assets using appreciated assets, I guess you'd want to most likely give higher basis assets if you could. But this is all subject to change based on proposed legislation, right?
Yes.
Great, thank you. I will end with this. First, huge thank you to our panelists. Mike, thank you very much. John, David, have a lot of respect for you as professionals and you do great work. I will leave you with a couple of thoughts that Mike shared, if I may, Mike. A few things you talked about, which I think are crucial. Have patience, communicate, both with your family and with your advisors. Have flexibility, have discipline. Create a family mission statement. Understand the purpose and intention for your family's wealth, and don't wait. At least get something started, get the infrastructure started, and I promise it'll make your life much easier and much more comfortable, even as the tax changes may come. Eventually, they will all change at some point in time. So there's no better time to start than now. Roseanne, back to you.
Excellent. Thank you so very much, folks. We appreciate your thought knowledge, and this was very inspiring. I'm going to start right away with my estate planning.
Thank you for having us today. We appreciate it.
Okay, we're going to end this session, and if you would like to stay on board, that's fine. Just hang out, and we will move to the next session very shortly at 10 o'clock. It's a perfect time to go get a cup of coffee, and we'll give you just a few minutes before we start the next session.
Thank you.
Thank you, everybody.